Sasa, a lot of this was known. We saw in the dot plot after the last meeting that the projections are they are going to raise interest rates up, the Fed funds rate up to 5.1%. We are now at 4.25 to 4.5%. So we do know we have maybe one or two more raises to go to meet their target. I think the key now moving forward that people have to keep in mind, and investors in particular, is the interest rate differential with the world. We were the first to aggressively tighten around the world, and I do believe we're going to be one of the first to stop tightening and to finish the tightening process, whether that's at the Fed meeting or the meeting thereafter. And what that's going to mean is that as the US rates stop going up and the rest of the world catches up, those relative interest rates in the rest of the world are going to be more and more attractive, which means money is going to continue to flow out of the US dollar and weaken the US dollar. And if you look historically, Sasa, that usually ignites a fire in the emerging markets for emerging markets equities. Once the dollar weakens, emerging equities start to get bid. And we've already seen it in the last couple of months. The US dollar is sniffing this out. It's weakened close to 10%. And then you have markets like China, which is close to 40% of the weighting in emerging markets, up, depending on the index that you look at, between 50 and 70% off of its recent lows in October. So there's a lot of opportunity moving forward, and this is a regime change. It's just getting started, and I think you're going to see some dramatic outperformance in emerging markets over developed markets in the coming years.
In terms of capital markets, amidst of recession fear, does the January effect still exist?
As far as the January effect goes, what we saw was we had a Santa Claus rally that actually took place the last 5 trading days of 2022 and the first 2 of 2023. Historically, when you get that, you see above average returns in the US S&P of about 9.8% versus 8.9% on any year. The other thing that we're looking at here is the presidential cycle, which is the 4-year cycle. We just got through the midterm year, which is the second year of the presidential cycle, and we're now moving into the 3rd year of the presidential cycle. Historically, since World War II, the second year is the worst year in terms of stock market performance, and 2022 lived up to that bad billing with the S&P 500 down 19.5%. However, what people are underestimating is the seasonally strong period of the first 2 quarters of the 3rd year of the 4-year presidential cycle, which we're just now starting, are historically the 2 strongest quarter for equity market returns. Now, with all the headwinds, people are distracted by the Fed, distracted by tightening, distracted by inflation, but I wouldn't be surprised if we saw much better than expected equity performance for the next 2 quarters, and no one's looking for it, no one's positioned for it, and that's usually when you get it.
Okay, in the next quarter, there will be a prospect for stock market. Thomas, regarding the potential for the Fed's interest rates still high in the near future, will investors consider investing in risky markets such as the capital market, or this is actually a good momentum to re-enter the capital market?
Yeah, I think that people are getting nervous, but you have to put it in historical context. So for instance, prior to the great financial crisis in 2008 to 2009, Fed funds rate were never this low. Now we've come from 0 to 4.25 to 4.5 in a very short period of time. But even if you look back as recently as the late 90s, when we had a huge boom in equity markets, the Fed's fund rate was 6.5% at that time, and equity still did exceptionally well. So the key is the context. So the last time we had an inflation bout this aggressive was 1980 to 1982 under Fed Chair Paul Volcker in the United States. And what happened was the S&P 500 corrected 27% peak to trough. We had a very similar peak to trough correction last year in the S&P 500, and everyone got bearish and very nervous. But what we need to keep in mind is that when the Fed is going to pause, they're not going to give us notice. And the exact same thing happened in October 5th of 1982, Paul Volcker had been saying up until that point, we're going to keep at it, we're going to keep at it, we're going to keep at it, we're going to keep raising rates until we kill inflation. Well, inflation was still 7% and coming down in October of 1982, but he changed from the words keep at it to the words may shift tactics. And even though inflation was still near 7%, the market on that minor shift rallied, and in the next 4 months, it recovered all of the 27% drop in the S&P 500 and went on to make new highs the next year. Now that's not saying that's definitely going to happen this time, but it is saying that I think people are underestimating, even if the Fed holds rates high and does not cut, holds rates, let's say they get to 5% and they hold them there for several years, equities can still do exceptionally well. We saw the exact same thing in 1994. The Fed had to raise rates very, very quickly that year. The stock market did poorly. And then they kept rates elevated from 1995 to 1999, and the stock market had 4 of its best years in history. So I think what we have to keep in mind is the Fed is not going to give us an invitation in the mail to go buy equities because they're going to be pausing in coming months. When they make that shift, it's going to be abrupt and it's going to be overnight, and the market's going to respond accordingly. So the way we look at it, Sasa, is you want to start to buy highest quality equities that are on sale. Some are down over 50%, that you look at out 2 to 3 years and you say, is this business going to be bigger in 2 to 3 years and doing well in 2 to 3 years than it is today? And if the answer is yes, now's the time to start to nibble in, because historically equities are a better hedge for inflation moving forward.
So in general, do you think main indexes of Wall Street still continue to decline?
Well, interest rates, I think, are going to go up for the next meeting or two, maybe 25 basis points, and then possibly another 25 basis points. And then at they're going to be held at those high levels. I think the stock market has already responded to a lot of pain that's going to cause, and did so with a peak to trough correction last year of over 25%. So, we don't know for certain where the bottom is, but we do think that more of the pain has already happened. It's already in the rearview mirror, and it's the time to be in the market buying high quality businesses that are already down 40, 50, 60% in some cases, and ease into them at this time, because when they stop hiking, if you wait for them to signal that it's already clear, many of these equities will have already had 30, 40, 50% moves. It's similar to the people who are waiting for Xi to end zero COVID. If they waited for him to end zero COVID, they would have missed a 40, 50% rally in equities, because equities started to rally ahead of the fact, not after the fact. And I think that's what you have to do here, is be prudent. They've given you their guidance that they're going to do a couple more hikes. So we know we're coming to the end of the tightening cycle in the US, and therefore it's an opportunity to get in these high quality business that are marked down.